rest of today's sessions very shortly. So I'm asking for your undivided attention. Everyone, raise your hand if you know that Bitcoin's below 60,000. Yeah, pretty brutal. But one sector that's also in an equally brutal position as crypto is private credit, which is what we're going to wax poetic about for the next 45 minutes. So we can introduce the folks that are coming on stage. We have an interesting discussion about the state of tokenization in the private credit market, moderated by Krisztian Sandor of CoinDesk. Very excited to welcome them on. Please join us. Thank you.
Frank, that was an awesome intro. Thank you.
Right, so some tokenized credit right after lunch as a dessert. So, well, we are not talking about Bitcoin below $60,000. Tokenized credit is a better position in terms of growth. So let's kickstart the conversation with a little bit of intro about yourself, but also with some substantial point of views, because you guys are coming from 4 different vantage points when it comes to tokenized credit. We have the traditional finance institutional giants, we have the Onchain originators, we have the data layer, but we also have insurance. So let's start with this. Why private credit needs tokenization? Why it needs to be tokenized? Is there any advantage for that? And sorry, Krisztian, you asked. But
sure.
I'm not relenting.
Yeah, no,
You're gonna start
I'm
off.
happy to kick it off. Is everybody paying attention, though? Are you all there? You all there? You ready to talk about on-chain private credit? Whoa, that was a weak response. Come on, guys. Let's go. Let's go. Okay, so, I mean, this is the way that I think about it. You know, digital, by the way, hello. For those of you that I don't know, I'm Christine Moy. I'm a partner at Apollo. Apollo is a $1 trillion private markets asset manager that also happens to specialize in private credit and private equity. We just call it private markets at large. And basically, digital assets is important to us for like 3 different categories. And this is like, hopefully will give you some context on, you know, why we spend a lot of time on tokenization. Also, by way of introduction, previous to being at Apollo, I was at JP Morgan for about 20 years, and I built and led JP Morgan's blockchain program. So I invented JP Morgan Coin, which is now kind of known as tokenized deposits, like basically every money center's response to stablecoins, and also created intraday repo, which in retrospect was just like a TradFi version of borrow lend, which has transacted trillions of dollars of tokenized dollars, treasuries, money funds, and mortgages, actually, since I took it live during COVID. So all of the things that TradFi has been building up to, still very relevant, and you know, just coming to into its own today. So, you know, for us at Apollo, like, you know, I would think of tokenization and on-chain finance as important for a few different reasons. The first category is, you know, obviously this is trillions of dollars that is, and composed of hundreds of millions of investors that are underbanked and underserved by asset managers. And then also they trend towards like, you know, a younger generation. And so as Apollo, as an asset manager, we want to meet this next generation of on-chain investors where they are, learn about their investing behaviors. Like, for example, like their first investment was Bitcoin in some ugly monkey picture. Whereas like, you know, if you're like a boring TradFi person, like my first investment was Apple equity, right? So understand like where they're at, meet them where they are, which is in their wallet, and grow with them and be with them as, you know, they get ready to, you know, kind of, I don't know, save for retirement, which is what we typically do, help people do. The second main category for why tokenization matters for us is we think that blockchain-based assets can have superpowers. And so in the past year, we've worked on tokenizing our private credit fund, and we've, you know, basically been able to confirm that this actually is true. The superpowers that I'm talking about is actually having the infrastructure to enable more liquidity for less liquid products, which are private markets like private credit and private equity, et cetera. So being more easily able to transact on a secondary market, as an example, or being able to use like these private assets as collateral, for borrowing and lending, like as you would see in DeFi protocols like Aave and Morpho. So really exciting that in the past year, since we've tokenized our fund, and this is like how fast on-chain finance moves, like we've actually been able to prove out that technologically, this is definitely much easier than the normal off-chain way. Now, still more work required to like figure out how to scale this, still more work required in terms of like, legal and regulatory stack, but that has been proven. The ultimate vision of where we're trying to get to is essentially full capital efficiency for both individuals and entities. The idea that I can get paid by Apollo twice a month and basically can have like my salary deposited as stablecoin dollars into my account, and that automatically deployed into different investments, multi-asset investments, what would include equity or credit or crypto or anything else that, whatever the kids are trading these days. And I can be fully invested, yielding and appreciating every penny of my earnings from the moment that I earn it to the moment that I spend it with my crypto wallet connected credit card. So that is like the overall setup for why tokenization matters to us as like a large TradFi institution. And so I would kind of think about kind of that in the context of like why tokenization is important in private credit and why private credit is important for tokenization.
Awesome. You almost spoiled like the whole conversation.
Oh, we can just dive deeper.
That's awesome.
I told you not to start with me.
That's true, but we're gonna unpack that in the next 30 minutes. So Sid, native on-chain origination. So what's the advantage for originating all these loans that Maple does? Since Maple started, it's in a couple billions so far. Mm-hmm. What are the advantages? What are the challenges?
Well, I think as you've seen with the journey of tokenized private credit. So initially, you have loans that are originated off-chain. They're housed in a fund, and then you take the fund and you tokenize that in some fashion, and people can buy it with stablecoins, or they can buy it with fiat and hold it in an on-chain wallet. If you look at Maple's business, so we've focused on over-collateralized lending, or rather institutional lending, but we source pretty much all of our capital comes from on-chain sources. So whether it's DeFi, or whether it's corporate treasuries, or asset managers, or individual investors, they put stablecoins into Maple smart contracts. And then so by just originating directly on-chain in stablecoins, we're able to cut out off-ramping steps that would have added time and cost and inconvenience to that product. So we find almost all of our borrowers, because we're typically dealing with crypto native firms, they want to borrow in stablecoins, whether it's USDC, USDG, USDT. And what we're finding is that as we are now kind of expanding the purview of who we lend to, so talking with fintechs, we're seeing there's now much more receptivity and willingness to consider borrowing in stablecoins than there was 12, 24 months ago. So I think, in a post-Genius world, stablecoins, or rather more of the transacting in capital markets is going to settle in stablecoins, and then you're just cutting out these extra inconvenient steps. You can have people then invest stablecoins, then the origination that produces yield for them, whether it's private credit or on-chain credit or lending against Bitcoin or lending against real-world assets, will just settle in stablecoins and they'll get the yield straight away, similar to what Krisztian was articulating.
Right. So we have these two sides, bringing assets on-chain, originating natively on-chain, but where does insurance fit into this, and what insurance can unlock for private credit? So especially like on-chain tokenized private credit, and that's for you, Gabriel.
Yeah, no, thank you so much. And a brief introduction to myself. My name is Gabriel Coleman. I'm the CEO of a company called ReAmplify. We are a Class 2 insurer out of our license out of Barbados. What is unique about us is that we use digital assets, including Bitcoin, ETH, and other blockchain-based assets like RWAs as balance sheet capital and regulatory capital to be able to underwrite our policies. The reason why I'm here, and why it even makes sense to have insurance even on this panel, is that we care very much about the security and the value of what private credit is actually lending against. One of our biggest businesses is underwriting data centers, specifically data center GPU depreciation. And so if you could think about many different categories of risk and how private credit ultimately is looking to underwrite certain kinds of risk, we in many of these instances are in that front line of what they're going to be underwriting, oftentimes being as that first layer of risk transfer for that particular private credit. And so the value that tokenization is able to bring, or that insurance is able to bring to all of this, is that private credit is able to have more expansion into what it can actually lend to by leveraging insurance products like ourselves and many others by filling these modern coverage gaps.
Okay, coming to you, Matt. Sorry, I left you for last, but not the least. So tokenized private credit is growing. What's missing from the data and infrastructure layers that needs to be built, that still needs to be figured out to scale that to, hundreds of billions of dollars coming on chain?
Hello, everybody. Matt here, VP of Business Development of Redstone, so the host of this conference. And the first thing I'll say is, as it stands today, and Apollo's Acrid, for example, is a great example of a fund that's already being used in DeFi. But on the data side of things, on the Oracle side of things, the job is rather simple. The Oracle is mainly the trusted relay of information that lives off-chain primarily. So specifically, the NAV of the fund comes from, if Securitize is the tokenization platform here, it comes from Securitize Fund Services. It's translated from SEC filings into a daily NAV there, and it gets relayed on-chain to be used as price, based on which a DeFi market, like a Morpho lending market, can actually exist. That's the job to be done today. So high level, rather simple. Low level, it's still non-trivial to keep it pushing on chain 24/7 with no hiccups, no downtime, even if the AWS region is down or stuff happens in general in the world. But that's the simpler job to be done. And I guess that's all right if you have the quality of the asset and the reputation that Apollo has and the scale. And in general, if the counterparty risk of dealing with you as the asset manager is well understood. Now, there's probably only a handful of global funds like this or asset managers like this that can really, have that privilege. Maybe more, but still, it's a subset of the market. Now, the big problem that we see is the fact that you actually have to go directly to the asset manager to understand what the price is, what the quality of the asset is, etc. So right now, we are thinking a lot also about the secondary liquidity of illiquid assets. Private assets are the best example of that. But in order to do it well, so let's say you have a position on Morpho that is collateralized by a private credit fund, and you want to get out of this position without having to unwind it manually or without having to go through the standard redemption period or using up the redemption buffer, which usually is between 5 to 10% of the AUM of the fund. Well, if you want to do it, you should theoretically have the ability to also get rid of the asset or unwind this position instantly using a form of secondary liquidity on the open market. However, since this is a private asset, you still have to do the manual check, the manual due diligence process on that particular asset, on the quality of it. So the big problem here is data provenance, basically, for anything that happens inside of that asset. And it's easy to talk about this problem from this theoretical stance right now. It's a very hairy problem, I would say. A good example or an analogy here would be actually consumer credit. Something that Figure has done, for example, with the origination of HELOC, where they've decided that the whole asset and the whole thing lives on the blockchain as the primary ledger of record, which makes it easy and perhaps programmable to be able to underwrite it if you are potentially a secondary liquidity provider, if you want to acquire that asset in this scenario that I've just described. Now, the big problem here obviously is that consumer credit has very, very different confidentiality assumptions, because when it comes to B2B private credit, the borrowers themselves require to be non-public, right? Require to have privacy. So for an asset manager, it's actually the know-how and it's actually the moat on the market to have all of that sort of just aggregated and not shown publicly, the whole loan book, and then just file the necessary SEC filings. But it does make it harder for everybody else who actually would like to acquire this asset on the secondary market to understand what that really is. And since, again, this is a private asset, usually there is only one source of truth for what's actually in it and what the price really is, as opposed to standard assets which have many different price sources, and the Oracle's job there is to go out to the broad market and get as much information on it as possible and try to consolidate that into a single price. So the big missing piece for sure is that data provenance aspect, although it's very non-trivial to be able to solve it well. There's also many different levels of stuff perhaps that you would like to show for just verifiability purposes, just by looking at a single loan book, and stuff that you cannot show because it would be a breach of fragile piece of information as well. But it seems like we are very much at the beginning of the journey of actually making private assets programmable in that sense.
Sticking with the infrastructure point, Krisztian, what would Apollo need to not just bringing assets on chain, but actually originating natively on chain?
Yeah, I think about this a lot. What Krisztian is referring to is that there's this concept of bringing off-chain credit on-chain, or just natively originating it, right? And I think about it a lot because I do think that the North Star that I have here at Apollo Digital Assets is to be one of the primary yield generators on chain, or at least to be one of the primary entities to bring all of this off-chain yield on-chain. Why? Why does it matter? If you believe in the adoption of stablecoins and you believe Genius Act compliant stablecoins and MiCA compliant stablecoins don't pay yield, then you have a whole host of users of stablecoins that are going to look for ways to deploy their stablecoin to generate yield. And so, we've been experimenting with the various formats, like tokenized funds is one approach. Certainly thinking about tokenizing assets, kind of at the credit asset level is another approach. And then, actually doing on-chain lending natively is sort of the other way to think about it. At least from my current observations, and we're still early stage here, I think it's really compelling, and I think it's something that will ultimately happen. But right now, on-chain originations is definitely smaller in scale than all of the off-chain originations that we do, because it's new, right? We're talking about new market participants, and I mean, there's only 300 billion of stablecoin out there, right? So it's just small in scale to start.
So what could be the inflection point? I mean, we have all seen this forecast about $3-5 trillion of stablecoin market cap by, depending on the forecast, a couple of years, maybe a decade, who knows? Even we have Scott Basson saying that it's going to be a multi-trillion-dollar market.
I don't think it's going to be it just flips a switch and it's going to happen. And here's the reason why. On-chain lending also has different characteristics. On-chain lending is more real-time. It's shorter in tenor, right? When we typically do originations, we count in years and multiple years, whereas anything on-chain is typically counted by block time. And there's always an expectation of instant liquidity or on-demand, liquidity or on-demand access. And so there isn't really a lot of natural pockets of capital that can, satisfy that type of lending, except for banks. Banks can definitely do it with deposits. I mean, whether or not they choose to is another story. How long it takes for them to get on permissionless blockchain and to use stablecoins that are contrary to their business model is another story. But there aren't a lot of natural pockets of capital for that. But as you have more stablecoin users than that are looking for yield, that actually creates those pockets of capital. And that's sort of what you see, collecting in vaults or in DeFi protocols as an example. So I don't think there's like an inflection point of like it just flips over and like suddenly on-chain originations is like this. Also, I think that from a risk profile perspective, it's new. So like when I get my conventional credit people to look at on-chain origination opportunities, like they need to like think through it and figure out and like basically draw from their existing toolkit, draw from their existing experiences, and then figure out how to modify it to do on-chain originations. It's not like off the shelf, like, like, hello, like I've been doing this for 35 years and I'm great at it and like now I can do this. I said, I'd love your perspective. I know that you're kind of in the space, in the zone.
Yeah, with the focus being
On-chain originations.
Yeah.
Versus like bringing off-chain credit on-chain.
Yeah, I mean, we just by dint of necessity, we began with on-chain originations, right? Because we source all of Maple's capital on-chain. And also, it was necessarily a smaller market than the one Apollo plays in. So the on-chain, the universe of borrowers on-chain is, it's hedge funds, it's exchanges, asset managers, Bitcoin-backed Bitcoin miners, retail lenders. But because it's a smaller industry, you're playing with globally distributed customers. So you also need the ability to do it on-chain. It's much harder for me to send a US dollar fiat loan out to Korea than it is to send USDC or USDT to these customers. So I think it's, we're very early, and as you pointed out, Krisztian, total stablecoin issuance is only 300 billion. So we're going to see that accelerate over time, and that will make it easier to do native on-chain originations. But that's kind of the outer boundary of how much we can lend, right? We can always only lend a percentage of the amount of stablecoin issuance that's in circulation, but that's growing post Genius Act. And we've also seen that there are now, like a big catalyst for this year is there are a number of neobanks and fintechs who are trying to make stablecoin earn programs available for their customers. So that's going to mean more inflows of customer dollars on-chain into stablecoins, whether that's explicitly shown in the user experience or whether it just looks like they're selecting an earn program for fiat deposits. And that will ultimately then, allow folks like us and in future other private credit players like Apollo to, to consider doing direct on-chain originations.
One thing I'll also add is, often like the enterprise blockchain dreams that I was born in was like, okay, blockchain for like automation and operational efficiency, et cetera. And, in the decade that I've been doing enterprise blockchain use cases, like you realize like, yes, that's true, but it's not the lead. It's just table stakes. You'll get it when you get it. But like if you sort of have a use case driven on operational efficiency, like it's just not gonna fly. Now, once you sort of start getting to this on-chain origination, you do get all of your enterprise blockchain dreams coming true. As in like you can like programmatically, essentially have like manage the life cycle events for a credit. You can actually design like specific mechanisms where specific lenders can get paid back before, like, and get the distributions from a fund or from a credit, like, and that in itself, that programmability, the flexibility in structuring and the automation is like twofold. Like first, you could probably design more secure credit structures that, basically have smart contracts enforcing some of the life cycle events and, kind of the credit risk. And then operational risk, if you will. And then the second thing is you can actually scale it. So I think the big dream that, I have also is there's like a ton of, maybe different types of originations that may otherwise not get addressed because either it's too short term or it's too small. And therefore, like a lot of operational cost and burden to like, figure out how to manage and administer. But then, if you have it on chain and you have perfect data, like essentially you can aggregate all of these small little things around the world and like make them into like, big originations in aggregate and not have like armies of people like trying to do reconciliations on it because you can just program that. So I think that is the ultimate dream for on-chain originations as well. But not the lead, just more of like the table stakes.
Yeah. Yeah, and just to add to that, I mean, there's an implicit question when you say, is it better to do originations on chain in stablecoins? There's not some kind of body that decides, okay, it's now better to do this on chain and then switches everyone over. It kind of begins with you having to find a set of customers who aren't already served by fiat or off-chain rails. So in this case, with most of the lending on chain, it began with lending to trading firms who needed stablecoins on centralized exchanges. And then it's progressed to retail lenders and fintechs. But the reason they do it is either an access question or it's the fact that they're in a different part of the world, and so they don't easily have access to US banking rails. But it sort of takes place little by little, competing for certain customers. It's not a decision that is made because the technology is inherently better from day one.
Right. I think there's a connected argument from you, Gabriel, when we had the prep call, that those firms who have all their cash flows in stablecoins on chain should have better terms for loans or insurance because there's a better view and better data about all their cash flows. Can you
not just loans. I would argue even like policies we write. I think for any D&O policy we would write for any company, if they had their cash flow, their balance sheet on chain, we would be able to underwrite that much better, more effectively. And I would also argue that modern private credit currently today, right now, probably suffers from a lack of transparency, and I think that a lot of redemption requests are ultimately fueled by, LPs into these funds not knowing exactly what the underlying is automatically. And I think that adding that transparency, I think, will actually allow for much more lending to actually take place in this current system.
From an insurance standpoint, how can you quantify? Because we talked about mostly so far about the advantages of getting assets on chain or originating on chain. We are touching on how to deploy those assets into DeFi, but I just want to start with the risks associated with DeFi, especially the recent wave of exploits. So from an insurance standpoint, how can you quantify and price those risks associated with DeFi? Because all these assets getting tokenized or originated on blockchain, that comes with special risks that's not prevalent off-chain.
Right. So I think when you think about insuring DeFi, right, there's like two different and with RWAs, there's like two sort of like things you think about, right? In one case, you have like permissionless on-chain assets, which can be freely transferred, secondary, and so forth, right? And so in that category, that's where you've seen like more traditional, traditional, if you even have a word for DeFi insurers, have gone into like the Nexus Mutuals of the world, Ion Hewitt, and other firms are looking into that space as well. I think the other side of it is really going to be underwriting the underlying of that, which ultimately, if the underlying doesn't do very well for any of these particular RWAs, then it doesn't really matter what happens on chain. So you have to be able to have the ability to actually make sure that both the underlying and also the supporting smart contract infrastructure has the risk mitigated appropriately to be able to underwrite that risk.
I think as well. I mean, we have dabbled with insurance in the past, whether it's taking out a policy for protection against smart contract risk. We have bug bounties for white hat hackers at Maple, and we've had the misfortune of being priced as a DeFi protocol for a D&O policy once as well. But we've seen various attempts at doing DeFi insurance. I think where it falls down is having like an effectively unlimited coverage, which is, I think, blew up a couple of DeFi or insurance protocols in the past. But I think it can be done, and we see more and more folks willing to step into the space to do that because there are some pockets of capital that have needed yield. Restaking was a prominent one. You've seen CAP and Singularity. Or Symbiotic, and they have pockets of either capital denominated in BTC or ETH or some other asset where it's actually quite difficult to get a yield, and so they're looking to put it up effectively as insurance capital to underwrite risks that could be hack related or credit related. But I think it's starting to happen. But you can just cap the notional exposure that you're willing to underwrite, so you don't cover a protocol for 300 million, you cover them for 30 million, and then you try and get some diversification.
Right. Matt, so one of the advantages of having all these tokenized assets on chain is deploying in DeFi, having them used as collateral. But from a data standpoint, what are those data points that need to be assessed to decide that this particular tokenized asset is good collateral or not?
So a lot of that comes down to understanding the asset in the first place and who is the asset manager. It's the secret sauce of how we operate a risk curator today as well, right? So the ability for you to do that due diligence basically determines if you live or if you die. And many of them have already died because of their procedures just not being enough, right? But in the pursuit of yield, they were willing to take risks that have proven to be just, reckless in hindsight. And what we are trying to do, where we are trying to help them out with, is the Oracle is the table stakes thing that you need to have to open the DeFi market in the first place. We have acquired a company called Credora in Q4 last year, which is DeFi risk ratings. And think about it in the context of S&P's or Moody's ratings, but specifically catered to the DeFi environment. Because if you just take the standard methodology and try to apply it to one of these assets that are used as collateral today, it's always the rating is always going to be lower just because it touches blockchains, just because it operates in this new environment. So it doesn't give you that much signal. So our job, we've taken a very pragmatic approach to it. Our job is not to compete directly with S&P or Moody's or other rating agencies. Our job is to provide signal to risk curators in DeFi in the first place, because if they have 300 asset issuers waiting in the line to get the due diligence process with somebody like Gauntlet or the other big risk curators, like, how do you know where to invest those resources? So our job with those ratings is just to come in and cut off 80% of that pipeline, so that they have that 20% where they really can invest the due diligence resources. So our job is not to replace their process; it's just to make sure that they can use those resources wisely. And that really is step one. To open the market in the first place in DeFi today. But there's also this whole other aspect of what happens if, so specifically the big risk of being a risk curator is bad debt and just having, to have a haircut on the deposits into your vault or market. And that comes down also to the secondary liquidity of an illiquid asset. Very relevant to private assets in general, and it all ties back to this provenance problem, to this understanding of the underlying data and what that is really, the asset that I'm trying to use as collateral. And the more we can dive deeper into that in a programmatic fashion, the more counterparties we are going to find that are going to be willing to take on that risk, perhaps to acquire it in the moment of liquidation on a morpho market, or if a party that holds this position has a private asset collateralized when they just want to get out, maybe at a slight haircut. So this is the other side of the market that we are working on, which is called Redstone Settle. So basically infrastructure for liquidating and instant redemptions directly from morpho, so that you don't have to unwind it manually. But what we need for that to happen is balance sheets, deep balance sheets that are going to be the backstop of that liquidity for these assets. But nobody with a deep enough balance sheet is going to be able to underwrite those assets if they don't really understand them well. So all connected problems on both sides of the equation. So you need to understand the asset before it gets to DeFi, and you really need to understand it to have secondary liquidity for it, to have proper LLTVs and parameters on that market, for the curator to be comfortable and to know that if something bad happens, the asset can actually get liquidated, so that they get stuck with it and that they don't have to incur bad debt on that market. But ultimately, it all comes down to that provenance problem.
Right. So we discussed on-chain origination, bringing assets on-chain, DeFi composability. Just as a quick recap, because running low on time, what do you expect to be the next big milestone for tokenized credit to really take off?
I think it needs to have a better user experience. I think that it has to have the same magical experience as, you know, what is experienced in overall like permissionless blockchain, but still be compliant. I mean, that's the thing. Like credit, or at least if you're bringing off-chain credit on-chain, and if you're having traditional institutions like participating in the credit markets, like it has to be, you know, KYC, AML, like reg compliant. And right now, all of that creates a lot of friction, which then, you know, sort of creates barriers to adoption. So I think if you could figure out the magic of like compliance with like a permissionless experience, like that would crush.
Matt, is that something that you are building?
I mean, we are not building this specifically, but any progress we can make towards native on-chain origination for these types of assets, it just makes our job easier, more interesting as well, because there's more stuff to do for an Oracle. There's more data to be interpreted as well. So that's definitely something that we are looking forward to.
Sid, what you keep your eye
I just think more stable coins. Like I think as we get, you know, to 500 billion of stable coins, there's naturally a demand for more yield, and that's going to push people into tokenized private credit. So I think that's, you know, just takes time.
Gabriel, recap.
You know, I would probably say it would be demands from LPs into private credit funds demanding more tokenization, more transparency into anything that they're deployed into.
Awesome. Thank you.
Thanks.
Woo!